Yeah, the answer is yes. 100% yes. Definitely.
You have to give her more information than that.
Yeah, it's a good point. All right, roll the intro. Let's do it. Let's talk about it. Okay, so this is one we get all of the time. And I completely understand because, I think for a long time, a lot of financial advisors have always said things like, "Oh, just, stay in the market for a long time. That's really what matters. Just be investing. The market's going to go up, the market's going to go down. Just the fact that you're investing is really what's important." I'd argue that's actually true. I think, you know, 80% of growing wealth is really just about being engaged in investing. And I do think if you have exposure to that in a general sense, that's always a good thing. But the whole markets will go up and markets go down thing definitely can be optimized and timed. So I'm going to give you a bunch of examples on that on this video because as a former hedge fund manager, I mean, you lose money, you lose your job. It's pretty straightforward. Financial advisors, it's a little bit different, all fair. The reason why I don't particularly love the whole, oh, markets go up and markets go down, it's just about staying involved in it kind of thing. To me, it's kind of like going to the doctor and the doctor's like, well, sometimes you're sick and sometimes you're not sick, just keep doing your thing, keep living, and, it'll be all right. If a doctor said that to you, you'd be like, well, no, give me a vaccine or penicillin or some medication, right? You're going to that professional to basically protect you from the downside, protect you from the bad things. That's exactly what we should be doing as financial advisors as well. In this video, we're going to talk a lot about, yes, you certainly can time the market. I'm going to give you a bunch of examples of that. I'm going to show you kind of how you can look at different pieces of the market to understand if it's a healthy market or an unhealthy market. And then the real key takeaway here too is that what is a market? Right? So a lot of folks will kind of talk about the stock market, the US stock market. Well, there's a million other markets, right? I mean, there's the fixed income market, there's the treasury market, there's the commodities market, there's European stocks, there's Asian stocks, there's, European and Asian fixed income and credit markets as well. So it really is more about what you're getting exposure to when and really making the most of that exposure. And I think that's really the critical element that a lot of financial advisors will miss, unfortunately. So when people say they want to time the market, but they're really thinking about, I don't know, day trading or something like that, it seems really attractive, but it's typically a pretty horrible strategy. What you really need to do when you think about timing the market is, how healthy is this market? Is it something I want to be exposed to because I feel like there's a greater probability of upside gain than there is for downside corrections? For example, I mean, one of the most famous investors of all time, Warren Buffett. Warren Buffett currently holds $400 billion in cash. He's been through many, many, many market cycles. And what he sees is what I see, although I'm certainly not Warren Buffett. And that is basically, if you're exposed to the equity markets, especially for the past bunch of years or so, the market is kind of rising and rising and rising and rising. And it's great. We're all making a lot of money. But it's all relative to kind of maybe what the average return on the market would be, which might be kind of something like this. And because the past few years is so outpacing kind of what the average market would be, a lot of institutional investors like Warren Buffett are going to basically trade to take profit. And if they're not going to trade to take profit, they're going to have their finger on the sell button. We always say in trading, it doesn't matter the event that causes the huge corrections. What matters is the market's reaction to that event. The reaction to a real, bull run, a reaction to selling off on a really high bull run is usually pretty severe because once someone sells, the price goes down. And then somebody goes, wow, the price, went down, I should probably sell. And then they sell. And then the next person sells, then the next person sells, so the next person sells, and that's what we call a bank run. And that's where you see these, especially in US equity, US stock market, it'll kind of go up slowly, but then really dip down hard because everybody's trying to cash in their profits. But that only happens when markets are overextended. When prices are kind of more valuable, when companies are more valuable. Valuable meaning their earnings and kind of what we project them to be is not too far away from what they are actually valued at the moment. You're much more kind of willing to jump in because, again, the upside is going to be much higher. There's much more probability of a big upside move than there is for a downside move. So yes, you can definitely time the market. However, it's a long-term, long horizon thing, and you really need to think about how the general market is behaving right now. So how do we do this? This is a question I get all the time. How do you know if a market is healthy or not? The honest answer is experience. Just being around a long time. Kind of a joke I always have is that I can't really predict company, prices and earnings and things like that, but I can certainly predict people. The predicting people thing is really in when markets are overextended like they are now. Everybody has their finger on the sell button, and it doesn't matter what the event is to cause the sell-off. It matters that because those markets are overextended, you're going to see a pretty big sell-off. As I mentioned, Warren Buffett has been doing this forever. He's certainly an investing kind of idol of mine because he has patience, he has discipline, he has a strategy that he really hasn't broken away from. He buys what he calls cigar butts, companies that have, mostly been exhausted, but there's a little something kind of still left in there. That's why he calls it a cigar butt. If you haven't read his book, by the way, or the book about him called Snowball by Schroeder, I highly recommend you do that. I will put the link in the description. Not only is it a great, just biography on Warren Buffett, but you're going to learn a lot about trading and investing in markets and things like that. So, but how do we know that? How do we understand what an overextended market is? So there's a few key ratios we look at. The first is a PE ratio. So you may have heard PE ratios thrown all over the internet. And what it means is on a per share basis, price per share, it's really how much is the market valuing that share, the future earning potential of that share, versus how much it's actually earning in cash. Right? What were the actual earnings of that company relative to how much we think or kind of are pricing in what the earnings are going to be in the future? So there's a few that we look at. I happen to use something called the Shiller-Cape ratio. But basically all the Shiller does is that it's a 10-year average instead of just kind of the past 12 months. Past 12 months doesn't really tell me too much. It's only 1 year, where 10 years gives me a much better feel for market fluctuations and seasonality and whatnot in the PE ratio. And right now, the Shiller-Cape ratio in the US equity market's about 40. Traditionally, if we kind of go back, for a very, very long time, it's been about 17. So it's more than twice as extended. We're kind of valuing stocks more in terms of their future earning potential than we have in the past. And obviously this is due to AI, but I would argue that's another sign that we look at, which is basically what's the concentration. So when we look at this bull market and it's taken off and everybody's making a ton of money and we're super happy and excited, what is actually driving that valuation? As of right now, about 35-40% of the value that is coming out of the S&P 500 is coming from the top 10 companies. So we have 500 companies in this index. 40% of the price of the S&P 500 is coming from its top 10 holders. So we're kind of putting a lot of eggs in one basket. And another way to look at this, and I look at this kind of from a risk perspective pretty continuously, is that, it only takes a sell-off of 10 companies, 10, mega cap tech companies to cause a huge market correction. There's not a lot of support in this bull run because it's only 10 companies, which is a huge problem. And then another one I look at pretty continuously is inflation. We can proxy inflation by CPI. Inflation actually doesn't have a super concise mathematical definition. Inflation is more of a concept, but we can use things like the CPI, the Consumer Price Index, to say what is inflation. And right now, it's the highest it's been since April 2023. It's about a little over 4%. They just released it on June 10th, I think. So a little over 4%, and the Fed is always trying to keep inflation around 2. So it's almost double what the Fed is trying to keep it at. When inflation's high, Fed will raise the rates. That makes debt more expensive. That makes expansion more expensive for these large companies. And theoretically, it brings prices down because basically it's harder to operate as firms. Just debt's more expensive, it's harder to grow, things like that. But the Fed has said, we're not gonna drop rates. We're gonna try to drop rates, but you've probably heard this kind of keep them higher for longer. basically implying that we're trying to get inflation under control without purposely raising rates. But I personally would not be surprised if they actually do raise rates because, as I said, 4% is twice as high as the Fed's mandated kind of role of keeping inflation to 2%. So long story short, yes, you can time the market. It is a long run, long horizon macroeconomic exercise though. You don't want to be day trading these things. You want to be thinking about, is the market healthy? If it is, I want to enter it. And if the market is not healthy, in my definition, my personal definition of an unhealthy market is overextended CAPE ratios, like I said, higher inflation, and a lot of concentration in these tech names. And why the tech names in particular is very important is because they are the first to be sold off on market correction. So 40% of your index is basically encapsulated in 10 names. It only takes 10 names to erode, we'll call it a pretty big chunk of the index. And that's why we see these huge corrections. So when I'm managing money for clients, I certainly am exposing them to healthy markets with healthy exposures that I feel like have a lot of upside. In the hedge fund world, the old saying is you can't control returns, but you can certainly control risk. You can control what you're exposed to. And if you can put yourself where you're kind of betting with house money and you feel like the market can kind of only go up, so to speak, you're in a great spot. But if there's a pretty significant chance where the market could go down, that is usually, in my opinion, something that I stay away from as a manager, regardless of the market I'm in, stocks, credit, currencies, commodities, whatever it is. You don't want to expose yourself to these really high concentrations of downside risk. And that's kind of currently what we're seeing in the market today. All right, so why? Why does that downside risk mitigation matter so much? And there's I have a couple answers to this, but the first real answer is kind of mathematical. If you have $100 and you lose $50, you're down to $50, right? That's a 50% correction. I argue that's a pretty large one. We don't see these in stock markets too often, luckily. But to get back to your $100, you have to double your money. So even though you were down 50%, now you need to be up 100%, do twice as much work just to get back to where you were. And every manager is a little bit different. Everyone kind of runs capital and books a little bit different. But my take is I always rather, especially in unhealthy markets, not join some bullish rally to the upside, just in case there's going to be a pretty big correction to the downside. I rather miss out on these little blips that go up that really cost kind of my client's capital by being greedy, kind of getting in these bull runs when there's a huge market correction. That's kind of one key reason why we do not want to do this. And then the other, like I said, is more human. Markets go down way faster than they go up. So it's easy when these markets go up, you feel pretty complacent, you feel pretty competent, frankly. You feel like you're on top of the world. I mean, we're making 20% in the S&P year over year over year. The crash is going to be much harder than the rise. So one's mathematical. You got to make back, let's call it twice your money when you lose half your money, just to get back to where you started. And the second is more human. The other piece to think about here too is, and again, I get this question a lot, mostly from traders, but sometimes from clients as well. How do you know when to get out? I used to work with a bunch of younger traders and they would get really excited about their entries on trades. They would say, I bought this stock at a really great entry point. And that's huge, right? That is a skill in and of itself. And that gets back to unhealthy markets. And healthy markets, find a healthy market, maybe one that has a lot of upside, not a ton of downside. The entry is important. But keep in mind, you only make money when you sell the stock. Right? You don't make money by holding the stock. I mean, you could argue you get dividends and things like that, which is very true, but you only make money when you sell. So when to sell is really the question of when have I kind of made enough profit to warrant the trade that I made. And again, these are long horizons. I'm not talking day trading or anything like that, although it certainly applies to day trading. And the market that we're seeing right now in the US, in the stock market, is these big institutional players that hold billions and trillions in positions, they've seen some pretty good profits. So now they're waiting for that moment to sell and kind of lock in the profits that they've made. So the answer is not really how can I predict the top? The question you should be asking is, have I made enough money to really capture some gain, and being okay, being mentally and psychologically disciplined enough to know that it's okay to miss out on more upside. It's kind of like you went to the casino and you won, walk away. There could have been an opportunity to make more money, but you didn't, who cares? So I think that's really what we care about. Thinking about healthy markets, getting in at the right time, and making sure there's room for upside, making sure there isn't a huge downside risk, which there is in the market right now, and then taking your profits. Because you don't want to be taking profits when everyone else is taking profits. That's a bank run, and that's a bad situation. Not to mention, then you have to take the profits. It's regardless of if you have the cash or not have the cash, or what liquidity looks like, or what your clients think. Don't be caught in the bank run. Take your money out of the bank before the bank is stressed to pay you. So let me show you a real example of this, how I actually look at it in the markets, and hopefully this will help kind of give a more tactical approach to what we're kind of thinking about and looking at as professional managers when we think about healthy markets and unhealthy markets. So I have here just TradingView, just kind of looking at, this is the SPY, which is basically an ETF that's just the S&P 500. So makes it really easy to trade, get exposure to the S&P 500. So, if we go back in time here, I did draw a couple lines here. You can see, this is last April when we had our tariff scare. There's a pretty big sell-off here. And I think it's actually a pretty good example because see these lines down here, these tiny little infinitesimal lines? These are volume, buying and selling volume. As an institutional trader, what I'm always thinking about is what other institutions are doing. So if you're Warren Buffett and you're freeing up $400 billion in cash, he just doesn't go into E-Trade and kind of hit a button and sell Apple and free up $400 billion in cash. It doesn't work that way. He has to do this over weeks, maybe months. And when an institution makes a play like that, over that amount of capital, over that amount of time, it's a commitment. And you can see that as the market was kind of humming along in this region here, so this is, late 24, we're kind of getting into 25, we start to see this sell-off. But what you see pretty immediately right here are these big red lines. See right here, you got these big red lines, and this is big volume, a lot of volume coming into this particular ETF, which a lot of institutions hold, and it's sell volume, it's red. And as a trader, I look at this and say, so even though, the price went down a little bit here, right? The price is here. The bank run is beginning, right? So I would have kind of exited in this week or so right here, because not only is the price going down, but there's a lot of volume on that. A lot of institutions are getting out. And if I was able to get out there, I basically would have been able to mitigate all of this craziness. If I was wrong, so I have these kind of big, red bars here. A lot of volume in the market, a lot of sell volume. And if I was wrong here, then I'm just wrong. I'm just holding cash. Yes, the market started to go back up. Yes, I did miss out on that upside, but that's purely a psychological effect, right? Especially as a client. This is when I started getting the emails, right? Hey, why are we not kind of participating in this bull run? I'm going to reevaluate. I'm going to take a look around. I'm going to look at my, Shiller cape ratios. I'm going to look at all the stuff that I look at. So you know what? I actually should get back in on this. I was just wrong. The worst thing I did was just miss out on potential earnings instead of exposing clients to a big downside. Okay, so now we kind of tick on and tick on. And as you can see, these spikes start to get kind of more and more frequent. The price didn't really go down, but the spikes get a little bit more frequent. And remember, these are daily bars. So as we're kind of getting to the end of 2025, what I'm seeing as institutional trader is something that Bill O'Neill, fantastic trader. I highly recommend you read his book. It's of all the books I've read on trading, I think Bill O'Neill's, I think it's called How to Win in Stocks, or How to Win with Stocks or something like that. I'll link it in the description. It is the best book on trading you could possibly read, because it's all based in not only his statistical analyses and experience. I think it's just very easy to understand. It's very intuitive to understand, where a lot of these trading books can get a little technical and complicated. But in a Bill O'Neill kind of framework, he calls these distribution days. And basically what these are the big institutions selling stock. They're selling their shares. They're taking profit. And if you see enough of these, you should be wary that if these institutions are getting out, there's really nothing kind of propping up prices anymore. We may see some retail action kind of here and there, but there's really nothing kind of propping this stock up. So big distribution days, we're kind of marching on. Now we're getting to, the end of 25, early 2026. And then not surprisingly, we're seeing a lot of red bars down here. And these red bars are more distribution days, more institutions selling. These are the things I'm looking for. If institutions are getting out, then I should be getting out because there's nothing going to be holding up the price. These institutional plays take days and weeks and months to kind of take hold. They can't just get back into them really quickly. The next thing I'm going to show you is something I really look for, and it's what I call the death row of a bull run. Now, this is not a video for, financial advice or trading advice. This is purely for informational and educational purposes only. All I can do is share how I think about markets. You can do whatever you would like to do. The reason why I call this the death row of a bull market is when this kind of drop below this level here, right? We have these big distribution days here, big distribution days here. It's almost like the institutions are kind of like, I'm going to lock in my profit, and this is like the kind of base of a price I would like to see. When that market then sells off again, a month or two ago, and now is below that, and again, big red bars down here. When the market is kind of below that, all of this is kind of like a retail move that smaller, investors that are in E-Trade and Robinhood and Fidelity or whatever it is, they can just go in and click a button and do whatever they want. It's pretty quick, small amounts of cash, relative to institutions. And this is this kind of huge uptick here. But the reason why I know this is that look how low this volume is. So even though there's some green bars down here because the price is going up, this is more kind of buy volume than there is sell volume, therefore the bar's green. What we can see is that it's really low volume. I'm gonna kind of put this line right here. You can see in this line that it's actually, this is kind of like, I don't know, maybe the average of that past 2 months buy volume per day is much less than all of the other lines before it. So even though it's buy volume, it's really weak buy volume. They're small orders, they're small traders, they're small retail traders. And that means there's not a lot of price resiliency. When we say, people say buy the dip. Buying the dip is basically retail trading. And as an institutional trader, I go, this thing's not going to last forever. Because not only are the institutions probably already out, but no one sells faster than a retail trader. Things are going bad, you're going to hop into that E-Trade account, that Robinhood account, that Fidelity account, whatever it is, you're going to trade that thing in a heartbeat. So I will say that at Pantile, in our client accounts, my personal accounts, we have zero exposure to US stocks right now. We're out of it, not just because it's an unhealthy market, because it's overextended and the PE ratios and inflation and things like that, because all that's still true. We're really out of it because this market's kind of in the death row of the bull run. And if you were to ask me my personal opinion, how do you know when you're at a top in a market? You know you're at a top in a market where you've had some distribution days, institutions are getting out, you may have this last kind of rally right here, but that last rally is retail. Thinking they're getting a discount, think they're buying the dip, think they're getting it on the cheap, but nothing is holding up that price. And that's when you know it's time to get out. Okay, so as I spoke about before, how do we do this at Pantile? How do we think about it? Well, as the chief investment officer, when I look at markets, when I think about client capital, the mindset I'm really going for is what do we want exposure to? Again, I can't control returns, but I can certainly control risk. And what I want exposure to are markets, again, it could be any market, not just the stock market. It could be debt markets, fixed income, commodities, currencies, real estate. It doesn't matter what it is. You want to get positive exposure to a market that has some good upside attached to it. You do not want to get into a market that's at its top. That is the absolute worst time to get into a market. Claude, by the way, or ChatGPT, Gemini, Grok, whatever you want to use, is actually phenomenal at this. Perplexity, phenomenal at this. You need to have great prompts for AI to get great answers. You can't say things like, is the stock market healthy? I mean, it'll give you an answer. But if you say things like, what is the Shiller Cape ratio relative to what it, right now in the market relative to what it's been in the past, or where is inflation now relative to where it's been in the past? All of these really specific questions, you can basically start to build like a market health dashboard. This is something that we have in our internal systems at Pantile. I actually built it myself, just given my years of experience in hedge funds and trading and working in markets and capital markets, things like that. But you can do this yourself. You can build a market dashboard, a market health dashboard to basically say, should I be getting into kind of a position right now, or should I be getting out of a position right now, or should I not be trading? It's the old trading maxim, but you're going to make more money not trading than you are trading. So you can do this yourself, and AI can really help you with this. If you ask the right questions, you're going to get some great answers. All right, so that's my take on timing the market. You absolutely can time the market. You definitely can. Traders all over the world do it. Warren Buffett's a famous example, but there are a million hedge fund managers that are great at it, a million, wealth advisors that are great at it, but it is a long-term play. It's a long macroeconomic, long horizon play. It's not a day trade play. I'm not a day trader. I'm sure there's a million other channels with great day traders on them. I'm not one of them. I am thinking about long-term client assets, retirement accounts, long-term growth assets, things like that. You absolutely can time the market. It's just more a function of knowing what market you're in and how healthy it is. And if you could do that, then you have a much, much, much better opportunity to time the market. The other takeaway here is it's really about discipline. Making money in financial markets is 95% psychology and maybe 5% math and science and finance and things like that. It's okay to not partake in bull runs when they're fragile. It's okay not to partake in rallies. It's okay to not make money as long as you're optimizing on not losing money. That is the number one thing that I would tell anybody. So yes, you can time the market. You just have to look at it from a long horizon. You have to know what market you're in, and you really have to be able to understand the health of that market. If you liked this video, please like it. Please subscribe to our channel. We're going to do a ton of these videos. We're going to try to do about one a week. They're going to be topic videos. Some are on markets like this one or trading. Some are on different types of investment accounts and how you can make the most of them. Please like the video, subscribe to our channel, and please comment. I want to hear from you. Do you think you can time the market? Has it worked for you? Has it not worked for you? And feel free to comment on any topic videos that you would like to see. Let me know, what you want us to talk about from a professional kind of money manager standpoint. The point of Pantile is to make the building of wealth accessible, to make it understandable. I'm really excited to hear what you guys put in the comments so we can talk about that, so you can learn as much as you can about building real wealth. Until next time, thank you so much for watching, and keep building that wealth.